Hello, thank you for tuning in. In this video, we'll be looking at the balance sheet. So the balance sheet is one of the few financial information that we get from a financial statement. So let us start by writing balance sheet. Okay, so the balance sheet. So it's a sheet of paper where you can get at any point in time the assets, liabilities, and equity of the company. So we have assets, liabilities, and finally equity. Okay, so these are the three main things that we can find in the balance sheet. So let me write down some examples like cash. Okay, let me first write down some examples so that you can figure out what assets are. Then we have inventories. So inventories are basically whatever you bought but you still didn't sell. Those are all your inventories. Next, you have plant, like a manufacturing plant, or property. You have property like real estate properties, and you have equipments that you use to create products. So that's shortly called as PPE. And finally, you also have other investments, like you invest in stocks or bonds and other short-term investments or long-term investments. So assets are usually categorized into short-term assets and long-term assets. So usually the PPE comes under long-term, and the cash and inventory cash usually comes in the short-term. And we'll give a real-life example in a short while. So let's talk about liabilities. In liabilities, we also have the short-term liability and the long-term liabilities. So the short-term liabilities is like short-term loans that we have taken. And there's quite a lot of names for that, like account payables. And we have notes payables. Those are basically short-term loans that we have taken. Okay, and we also have the long-term loans. Let's say, for example, the companies have to pay mortgages for the buildings that they have rented or they have bought. So those are an example of the long-term debts they may encounter. So finally, we are at equity. So equity. Okay, so equity, the first thing we have on equity is called the common stock. So the common stock is basically signifies the ownership, right? They put the initial money for getting into the company, and the retained earnings. The retained earnings always contribute to the equity base, right? So the retained earnings are the earnings that are retained after the net income is created by a company. So the net income, half of it, some of it goes to retained earnings, sometimes some of that goes to dividends. So the retained earnings, accumulation of retained earnings is the equity base. So an important equation is assets is equal to liabilities plus the shareholders' equity. So this is a very awesome way to look at it. So let us now talk about, there are like two types of equity. Very interesting, right? So the first type is, let's say, is the market value of equity. So it is the value of equity given by the market. So there's a market. Usually this is the stock market. So this is calculated by the stock price, the current stock price, multiplied by the total number of shares outstanding. So let's say, for an example, the stock price currently is $2, and there's total 10,000 shares. And the answer is about $20,000. So that is the market value of equity. And there is another value of equity, which is the book value of equity, which is that. And we get that from basically from the financial information of a company in their annual reports. It's easy to figure that out. Okay, so let us create a ratio. We have learned these two equities, so let's just put one on top and one on bottom. Okay, so let's put market value of equity on top, and let's just put book value of equity on bottom, and let's just call it market to book value of equity, or market to book ratio, is equal to the market value of equity on top, market value of equity on top, and the book value of equity, the book value of equity in the bottom. So this is a very useful ratio. Let me tell you why. So let us imagine in a certain scenario that this ratio is very low. That means the book value of equity in the denominator is very huge and the market value of equity on the numerator is very small. This signifies that the market has not realized the value of the company. So this is called the low value stock. And this is the roots of where value investing was found. And in a high value ratio, what happens is the market value of equity is really high and the book value of equity is very low. What happens here is that people believe that this company will grow in the near future, and that is why the ratio is justified. How the ratio is justified. Okay, so let us go on to visiting more interesting topics. So the next topic is called the enterprise value. So let's say you have loads and loads and loads of money and you're thinking of buying a company. And so the company is already, let's assume that the company, in this case, it has to be publicly listed. So that's how we'll get the market value of company. So you want to acquire this company for whatsoever reason you want to buy this company. So that is the enterprise value. So we calculate the market value of equity, right? We already have the formula over there. We calculate the market value of equity. And after that, we add the debt. We add the debt. Then we subtract. We add the debt. So this is the debt of the companies, and this is coming from usually the liability side of the balance sheet. So we get the debt from the company and we subtract the cash that the company has. And why we do this is because we're using the company's assets, like its cash, to pay off its liabilities, its debt. So we we put some money up front and we borrow some money and buy the company, and we use its cash to pay off its debt, and finally we acquire the whole company. Okay, please feel free to rewind to understand that much better. So let us go on to the next important thing, which is called the net working capital. These all are derived from the balance sheet, and that is why we're going over them right now. So the net working capital, this equation, net working capital, is equal to the current assets minus the current liabilities. This helps us to determine if the company has cash for their short-term needs, because we're calculating current assets minus current liabilities. In usual successful companies, it has to be a positive number, or else they wouldn't have cash to pay their short-term cash needs. So the net working capital is very useful. So let us quickly go and see a real-world example of a company's balance sheet. Okay. So let us take the sec.gov and go search for Apple. Let us go take the 10Q statement for Apple. 10Q, if you don't know what 10Q is, please go and check out our videos on disclosure of financial statements. Okay, so we have financial statements over there. We come down. Okay, balance sheet. And we have assets, current assets, and total current assets is there. We have non-current assets, which basically means, okay, marketable securities. Okay, we will talk about that a little bit later, but for now, let's cover what we have written down: liabilities and shareholders' equity. And we have current liabilities, we have non-current liabilities, which is basically long-term liabilities. And we have total liabilities and common stock and retained earnings. You see, we have covered all the basic required stuff, and they have laid it down from top to bottom. Okay, so thank you for watching this video. If you really like the real world example, please feel free to subscribe and check out the website. Thank you. Have a good day or night.